Imagine this scenario. You have finally saved up enough for a down payment. You've scoured the listings, you've fought through the brutal bidding wars, and against all odds, you finally find it. The one.
Mm-hmm.
You go through the endless paperwork, you sign your name about 100 times at the closing table until your hand cramps, and you get the keys. You move in.
The dream.
Exactly. You paint the walls that perfect shade of greige. You start imagining your kids growing up in the backyard. And then, 6 months later, there is a knock on the door. It's not a neighbor bringing cookies.
Oh, no.
It's a stranger holding a piece of paper that says they actually own the land your house sits on. Or maybe it's a tax collector saying there is a massive unpaid debt attached to the property from 3 owners ago, and they're here to collect or foreclose.
It sounds like the plot of a horror movie for suburbanites, doesn't it?
Yeah.
It triggers that primal fear of displacement. But this is actually the fundamental risk that underpins the entire American real estate market.
It is.
It's the nightmare scenario that created the industry we are diving into today.
It is terrifying. And today, we're unpacking something that almost every homeowner pays for, but almost no one actually understands.
Yeah.
We are talking about title insurance.
Right.
And look, I know what you're thinking. I can hear the collective sigh through the headphones. Insurance. Really? We're doing a deep dive on insurance. But trust me, the story behind this is wild. It involves a 19th century legal drama, a fundamental split between how the U.S. and the rest of the world handle property, and a system that is designed to look backwards rather than forwards.
It really is fascinating when you dig into it. Title insurance is technically a form of indemnity insurance. It is predominantly found in the United States and Canada, which is the first clue that we are dealing with something unique to our legal system.
That's a good point.
Its purpose is to insure against financial loss, from defects in the title to real property, or from the invalidity of mortgage loans. But unlike other insurance, it's not about probability, it's about history.
Right. And usually when we buy insurance, like for a car or a toaster or our health, we're worried about what might happen in the future. Will I crash the car? Will the toaster explode? Will I get sick?
You're betting against the future.
Exactly.
Yeah.
But title insurance is different. It's worrying about what already happened that you just don't know about yet. It's like buying insurance against having a secret evil twin you never knew about.
That's a colorful way to put it, but yes.
Yeah.
Unlike buying a toaster, which is a fresh object off a factory line, land ownership has a long tale of history. That plot of land has been owned, sold, divided, and borrowed against for potentially hundreds of years.
Wow.
The mission of this deep dive is to explore why this specific financial product exists to manage that history, the legal case in the 1800s that sparked it, and why, as you mentioned, the U.S. system of property ownership is fundamentally different from the vast majority of the industrialized world.
So we have a stack of sources here to guide us. We're doing a deep dive primarily into the comprehensive Wikipedia entry for title insurance, but we're also pulling on legal analyses of the Watson v. Muirhead case, historical records regarding the Torrens system, and industry reports on loss ratios.
A lot to unpack.
A whole lot.
Yeah.
So let's get into it. Where did this all begin? Because people have been buying land for a long time, long before 1876. How did they do it back then?
They have. And for a long time, the rule of the land was a Latin phrase you are probably familiar with, caveat emptor.
Buyer beware.
Buyer beware.
Okay.
It sounds harsh, but that was the legal reality. Prior to the invention of title insurance, if you were buying real estate, you bore the sole responsibility for ensuring the validity of the land title held by the seller.
All on you.
All on you. You had to do the homework. If the title turned out to be invalid later, maybe it was fraudulent, maybe there was a long-lost heir who suddenly returned from the war, the buyer lost their investment completely.
That seems incredibly high stakes. You could pay for a farm, work the land for a decade, and then poof, it's gone because of a paperwork error 50 years ago. There was no safety net.
None. If the title was bad, you didn't own the land, period. It's as simple as that. And that high-stakes environment leads us directly to the catalyst case. It's a Pennsylvania Supreme Court case from 1868 called Watson v. Muirhead.
Watson v. Muirhead.
This is the origin story.
Okay, set the scene for us. Who is Watson and who is Muirhead? What are we talking about here?
So Watson is our plaintiff. He's an investor looking to buy some real estate in Philadelphia. He's doing what savvy investors do. He's trying to be careful. He's not just throwing his money around.
Right, he's doing his due diligence.
Exactly. Muirhead is the defendant, and he is a conveyancer. Now, we don't really have conveyancers in the same way anymore, but in the 19th century, a conveyancer was the professional you hired to handle the transfer of property.
So like a mix between a title searcher and a closing agent today?
That's a great way to think about it, yes. So Watson hires Muirhead to check the title on a property he wants to buy.
Standard procedure. Check the records, make sure I'm good to buy this, here's your fee.
Right. Now, here is where the drama starts. Muirhead actually did his job. He scoured the records, and he found something. He found a prior judgment lien on the property.
A lien, just to clarify for everyone, that's a legal claim, right?
Yeah.
A debt attached to the property itself.
Yes, a lien is essentially a legal claim on assets, which allows the holder to obtain access to the property if debts aren't paid. So if the previous owner owed money, the creditor puts a lien on the house. If the debt isn't paid, the creditor can take the house.
Okay, so Muirhead sees this. He's not asleep at the wheel.
Not at all. He sees this judgment lien. He doesn't ignore it. But conveyancing law is tricky. He wants to know if this specific lien is actually enforceable against the property Watson wants to buy. So he goes to a lawyer.
He calls in the cavalry. Smart move.
He consults a prominent attorney and asks for a professional opinion. He asks, is this lien valid? Is it going to be a problem for my client?
And what did the lawyer say?
The lawyer erroneously determined that the lien was not valid. He looked at the statutes, looked at the judgment, and gave his professional opinion that it wasn't a threat. He basically said it was junk paper.
Oh.
So, armed with this legal opinion from a respected lawyer, Muirhead goes back to Watson and says, the title is clear. I found a lien, but my lawyer says it's garbage. Go ahead and buy.
I think I see where this is going. And it's not going to a happy place. Watson buys the land.
He buys the land, he puts his money down, and of course the lawyer was wrong, the lien was valid, the creditors came calling, they foreclosed on the property to pay the debt, and Watson lost his investment. He was out a significant amount of money.
Okay, so Watson is sitting there, he's bought the land. He's presumably happy. And then the creditors knock on the door and say, actually, this land belongs to us to pay off a debt. Watson loses the farm.
Literally.
Literally. So naturally, he turns around and looks at Muirhead, the guy he hired specifically to prevent this very thing from happening.
Right. He sues Muirhead. The logic is simple. I paid you to check the title. You said it was clean. It wasn't. You owe me my money back. It seems like an open and shut malpractice case.
Please tell me he won. Because if I paid a mechanic to check my brakes, they said, you're good, and then my brakes failed. I'm suing that mechanic into oblivion.
You would think so. It seems like the most logical outcome. But the case goes all the way to the Pennsylvania Supreme Court in 1868. And the judges, they pause. They look at what Muirhead did.
Okay.
He found the lien. He didn't hide it. He went to a lawyer, a prominent lawyer, by the way, and asked for an opinion on that lien. The lawyer said, don't worry about it.
So Muirhead got bad advice, passed it on to Watson, and Watson paid the price.
Exactly. And the court ruled that because Muirhead acted in good faith and followed the standard custom of consulting a lawyer, he was not negligent. He made a mistake, yes, but it was an honest mistake.
An honest mistake.
An honest mistake. And under the laws of 1868, you couldn't be sued for an honest mistake if you were following professional standards. Muirhead was off the hook.
That is wildly unsatisfying. That leaves Watson holding the bag. He did everything right. He hired the expert, he paid the fees, and he still lost his investment with zero recourse.
It was a shock to the system. It sent a chill through every investor in Philadelphia because it revealed a terrifying gap in the economy. You could do everything right and still lose.
Yeah.
The aha moment wasn't that conveyancers were bad at their jobs. It was that negligence law wasn't enough to protect capital. They didn't need a better lawyer. They needed a financial guarantee that paid out even if no one screwed up.
I see. So if you can't sue the conveyancer for an honest mistake, you need a different product. You need an insurance policy that pays out purely based on the fact that you lost money, regardless of whose fault it was.
Exactly. They realized that professional opinions weren't enough security for big financial investments. The market saw a need, and it responded quickly. In 1874, the Pennsylvania legislature passed an act specifically allowing for the incorporation of title insurance companies. And just 2 years later, in 1876, a group of colleagues met in Philadelphia to form the very first one.
And what was it called?
It was called, very creatively, the Real Estate Title Insurance Company of Philadelphia.
I love literal naming conventions. We insure real estate titles in Philadelphia. Done. No marketing fluff.
It gets the point across. Their stated mission was to insure the purchasers of real estate and mortgages against losses from defective titles, liens, and encumbrances. He promised that through these facilities, transferring real estate would be speedier and more secure than heretofore.
Heretofore. I love 19th century business speak. It sounds so formal. So who bought the first policy? Do we know? Is that lost to history?
We do know, which is amazing. One of the founders was a conveyancer named Joshua Morris. The very first policy was purchased by his aunt.
Of course it was. Hey, Aunt Mildred, I've got this new product for you.
Something like that. She bought a policy for a home on North 43rd Street in Philadelphia. The home was valued at $1,500.
$1,500 for a house. I know, inflation and all that, but still, that hurts to hear. So, Joshua Morris's aunt is patient zero for title insurance. This solves the problem for Americans. But you mentioned earlier that this is largely a U.S. and Canada phenomenon.
That's right.
Why didn't the rest of the world look at this and say, hey, great idea, let's do that too?
Because they solved the problem a different way. And this brings us to the really heavy conceptual difference: recording versus registration. This is probably the most important technical distinction to understand about American property law.
Okay, let's unpack this. Because I think most people assume that when they buy a house and record the deed at the county courthouse, the government is confirming they own it.
That is the common misconception. The U.S. uses a land recording system. In a recording system, the government is essentially a giant filing cabinet.
A filing cabinet.
That's it. You bring a deed, they stamp it, they index it, and they file it. The government recorder does not read it to see if it's legal. They don't check if the seller actually owned the land. They don't check if the signature is forged. They just file it.
I want to stick on this distinction because I think it's the hardest part of this whole topic to grasp. When I walk into a county clerk's office and I hand them a deed, I assume they are checking it. Like if I try to deposit a fake check at a bank, the teller stops me.
Right.
You're saying the government recorder doesn't do that?
Not in the way you think. Think of the U.S. system, the recording system, like a bulletin board in a college dorm.
Okay, I'm with you. An analogy. I like it.
If I pin up a flyer that says, I am selling this bike for $50, the college doesn't verify that I actually own the bike. They don't check the serial number.
They just provide the board and the thumbtack.
Exactly. The board is the public record. If you buy that book and it turns out I stole it, the college says, hey, we just own the corkboard. You should have checked. In a recording system, the risk is borne by the user, not the public.
That is horrifyingly simple. That is the U.S. system.
That is the U.S. system. Now, most of the rest of the industrialized world, Europe, Australia, the UK, they use a land registration system. It's often called the Torrens system, named after Sir Robert Torrens, who developed it in Australia.
And how is the Torrens system different?
The Torrens system, which is what Europe, Australia, and Canada use, is more like the DMV.
The Department of Motor Vehicles.
Okay. When you sell a car, you don't just pin a note on a board. You go to the DMV. The DMV takes the old title, cancels it, and issues a brand new one in the new owner's name. The DMV guarantees that the new title is valid.
So the government puts its stamp of approval on it and says, this person now owns this thing.
Yes. And if they mess up, the state pays for it. They have an indemnification fund. The government guarantees the title. The risk is borne by the public.
The DMV model sounds infinitely safer. Why on earth did we reject that? I see in the notes here that we actually tried to switch to the DMV model in the early 1900s.
We did. This is a forgotten chapter of history. Between 1896 and 1917, 19 U.S. states adopted some form of the Torrens system. Minnesota, Massachusetts, New York, they all gave it a shot.
19 states. That's a serious effort.
It was. They tried to move to a system where the government guaranteed the title, which on the surface seems so much more secure and efficient for the consumer.
But clearly it didn't stick, since I just paid for title insurance on my house. What happened? Why did 19 states give up on a better system?
A few things happened. First, there were disasters. There was a famous case in Imperial County, California. A single judgment regarding a title error was so massive that it completely bankrupted the state's title indemnification fund.
Oh, wow. So the government realized, wait, backing all this land is expensive and one big mistake can wipe us out.
Exactly. When the fund goes bust, the guarantee is worthless. It showed the states the potential liability they were taking on, and it scared them.
So financial risk was a big part of it. But there must have been more.
There was a stronger force at play: the lenders and the skyscraper argument.
The skyscraper argument. Is this about building heights?
It's about financing complexity. Carl Llewellyn, a famous legal scholar, put it this way. Imagine you want to build a skyscraper in New York City. You need to buy up a whole city block consisting of maybe 20 different lots.
Okay, a huge, complex assembly of land.
Right. Now, if even one of those lots has a Torrens title, meaning it's dependent on a government bureaucracy to certify it, and there is a dispute or a delay, the whole project stalls.
Because bureaucracies are slow.
Yeah.
You're waiting in line at the DMV 20 times.
Exactly. And if there is a dispute on plot number 12, the bureaucrat freezes everything. A government official has to follow the rules strictly. They can't take risks.
They can't make a judgment call.
They can't. But a private insurance company, they are capitalists. They can look at plot number 12, see a minor error, and say, you know what, we'll take the risk. Here's your policy. Build the tower. Llewellyn argued that a Torrens title on one lot could render a whole block unavailable for skyscrapers because lenders wouldn't finance it without the speed and flexibility of private insurance guarantees.
So capitalism won. The banks wanted speed and certainty that they could control, not a government queue.
That, and let's not underestimate the industry opposition. By the time Torrens was being tried, the title insurance industry was already established. They lobbied hard against registration systems.
I was going to ask about that. They wouldn't just sit by and watch their business model disappear.
Of course not. They argued that registration systems were vulnerable to fraud, which is true. Fraud happens everywhere. And that the complex countermeasures required to stop fraud in a government system were too expensive for the taxpayer.
Cartel language. Is that fair?
Some critics have used that word. A 2007 book titled The American Title Insurance Industry, How a Cartel Fleeces the American Consumer, subtle title, right?
Very subtle.
Argued that the industry successfully killed off the superior Torrens system to protect their business model. But the industry has a defense.
And what's that?
They argued that a system of recordation combined with private insurance is actually more robust because it decentralizes the records.
How so? What does that mean in practice?
Well, look at the San Francisco earthquake of 1906. The fires destroyed the public records hall. All the government records of who owned what were ash.
A complete wipeout of the official record.
Right. But the title companies had their own private records, their title plants stored elsewhere. They were able to reconstruct the ownership map of the city. If it had been purely a government monopoly, that data might have been lost forever.
That is a pretty strong point for redundancy. Okay, so we are stuck with the recording system, the bulletin board model. We have to do the homework ourselves, or rather, we pay these companies to do it.
Correct.
Let's move to segment 3 and talk about how this actually works, because earlier you said title insurance is retrospective rather than prospective.
Right. This is the key to understanding why the premiums work the way they do. Most insurance, think car, health, life, is risk assumption. The insurance company assumes the risk that a future event might happen.
They're making a bet.
They use actuarial science to guess the probability of you crashing your car or getting sick. They are betting on the odds.
But title insurance isn't a bet on the future.
No, it's risk elimination. They aren't betting on the odds of a hidden error showing up. They're spending the money up front to make sure there are no hidden errors.
So they are detectives, not gamblers.
That's a great analogy. The premium you pay isn't really for the payout pool, it's for the investigation. In the industry, they call this the search and exam.
The search and exam.
They go to their title plant, which is a cool term for their massive database of geographical indexes, and they trace the chain of title back 40, 50, 60 years.
What does a title plant look like? I'm imagining a greenhouse, but with file cabinets instead of flowers.
Think less greenhouse, more Indiana Jones library. Historically, these were massive rooms filled with tract books. While the public records are filed by name, a grant-to-grantee index title plans organize records by geography.
So they have a specific page for Lot 4, Block B.
Precisely. It makes searching the history of a specific dirt patch much faster than searching by names, which can be misspelled or common. Nowadays, it's mostly digitized, but these databases are proprietary and massive. They're the company's crown jewels.
And do they actually find stuff? Or is this just paper pushing to justify a fee?
They absolutely find stuff. There is a statistic often cited by the American Land Title Association, or ALTA. They claim that more than 1/3 of all title searches reveal a problem that must be fixed before closing.
1 in 3. That's incredibly high. If 1 in 3 cars on the assembly line had a defect, the factory would be shut down.
It is high. Now, many of these are minor. Unpaid local taxes are common, or a mortgage that was paid off but the release was never properly recorded. But sometimes it's weirder.
Like what?
A mechanic's lien is a classic example. Let's say the previous owner fixed the roof in 1995 but got into a fight with the contractor and shorted him $500. The contractor filed a lien. That lien sits there, accruing interest, for decades.
So if I buy a house and the previous guy didn't pay the roofer in 1995, and I don't have title insurance or a proper search, the roofie can come after me.
They can put a lien on your house, yes, because the debt attaches to the land, not just the person. And if you don't pay it, they can force a sale of your home to satisfy their 20-year-old debt.
That is terrifying. It's like buying a used car and finding out you owe the mechanic for an oil change done 10 years ago.
Exactly. And this is what the title search is designed to find and fix. This creates a very unique financial structure for the insurance companies.
How so?
In most insurance, like car insurance, maybe 80% of the premiums go to paying claims and 20% covers operations and profit.
Right.
In title insurance, it's flipped. Roughly 80% of the premium covers the professional work, the search, the examination, the curative work. Only about 20% goes into the insurance reserve for paying claims.
Because if they do their job right, there shouldn't be any claims.
Exactly. A claim in title insurance means the search failed. It's an error. The goal is 0 claims.
Another thing that makes it unique is the payment structure. I feel like I am constantly paying premiums for my car and my health. But title insurance was just one check. One and done at closing.
Yes, a single premium at closing, no annual fees. And the coverage lasts as long as you or your heirs retain an interest in the property.
Wait, or your heirs. So if I pass the house down to my kids, the policy I bought in 2024 still covers them.
Typically, yes. The language of the policy usually extends coverage to heirs as long as they acquire the title from you. It's a very long-term product for a one-time fee.
Okay, that makes the sticker shock a little easier to swallow. There's a lifetime guarantee. But let's talk about what we are actually buying. Because I remember looking at my closing documents, which was a stack of paper 3 inches thick, and seeing lender's policy and owner's policy.
The 2 policies.
I just signed both because I wanted the keys. Why are there 2? Why isn't it just one policy for the house?
This is the most common confusion for home buyers, and it's dangerous if you get it wrong. The lender's policy is mandatory. If you are getting a mortgage, the bank will force you to buy this.
And I pay for it, even though it protects the bank.
Yes. You pay the premium. It covers the bank's interest, which is the loan amount. So if you have a $400,000 mortgage, the policy insures the $400,000.
Okay.
If the title turns out to be bad and the house is lost, this policy pays off the bank. But it does not protect your equity.
So if I put $100,000 down and the house is taken away because of a title fraud, the bank gets their $400,000 back and I get nothing. I lose my down payment.
If you only have a lender's policy, yes. You lose your down payment and any principal you've paid. Your investment is wiped out.
Oh my God.
That is why the owner's policy is critical. It is technically optional in many places, but you would be crazy not to get it.
It sounds like it.
The owner's policy covers the purchase price. It assures you that the title is vested in you. And crucially, it covers legal defense costs.
That's the big one. If someone sues claiming they own my porch because of some 100-year-old survey error, I don't have to hire a lawyer.
The title company has a duty to defend you. And property litigation is incredibly expensive. Even if you win, the legal fees could bankrupt you. The policy covers that.
Okay, so get the owner's policy.
Yeah.
Got it. Now, let's talk about shopping. Because when I bought my house, my real estate agent just said, use this title company. And I said, okay.
Yeah.
I assumed it was like the gas company. You just use whoever services the area. Did I mess up?
You didn't necessarily mess up, but you might have overpaid. This brings us to a very important federal law called RESPA, the Real Estate Settlement Procedures Act.
RESPA.
Sounds friendly.
It is friendly to consumers. It explicitly gives you the right to choose your title insurer. Federal law says that banks, brokers, or attorneys cannot mandate a specific company.
But they can recommend one, right?
Mm-hmm.
And I imagine their recommendations carry a lot of weight. They can recommend, and they often do, but they cannot require it. And there is a specific section 9 of RESPA that is fascinating. It says that sellers cannot require a buyer to use a specific title company as a condition of sale.
So a seller can't say, I'll only sell you this house if you use my brother's title company.
Correct. And if they do, and you catch them, the penalty is severe. The buyer can sue the seller for 3 times the title insurance charges.
Triple damages. I like that. So the government really wants to protect our choice here.
They do. And this extends to the transparency of the costs. Have you heard of the loan estimate, or LE?
Yes, that's the standard form you get when you apply for a mortgage. It breaks down all the costs.
Right. It used to be called the good faith estimate, but
Yeah.
the new loan estimate from the CFPB, the Consumer Financial Protection Bureau, is much stricter. It puts lenders in tolerance buckets.
Tolerance buckets. Explain. That sounds like jargon.
It is, but it's important. So when a lender quotes you a fee on that form, they are held to it. There are three categories. First is 0% tolerance.
Zero tolerance. Sounds serious.
It is. These are fees for things you cannot shop for, like the appraisal or credit report fee from the lender. If the lender says the appraisal will cost $500 and it ends up costing $600, the lender has to eat that $100 difference. You pay 0% more.
Okay, I like that. What about title insurance? Where does that fall?
Title insurance usually falls into the 10% tolerance bucket if you use the provider on the lender's written list of service providers.
So if I go with their recommendation, the price can't go up by more than 10% from the initial quote.
Exactly. If the aggregate of all those 10% bucket fees goes up by 15%, the lender has to pay the 5% overage. This stops bait and switch tactics where they quote you a low closing cost to get you hooked and then jack it up at the signing table.
That is a huge consumer protection.
Yeah.
But who actually sets the prices? Can I haggle? Is it like a car dealership?
It depends wildly on where you live. This is a state-by-state regulation map. The rules are all over the place.
Give me some examples. What are the extremes?
Okay, the biggest extreme is probably Texas. The state sets the exact rate. It's called promulgation. You can shop for better service, but the price for the policy will be identical at every single company. It is set by law after a hearing each year.
So in Texas, haggling is useless. You're just shopping for who answers the phone faster.
Correct. But then you have states like Illinois or Georgia where there is no direct rate regulation. Insurers set their own rates. So there, shopping around could save you hundreds or even thousands of dollars.
And what about Pennsylvania, the birthplace of the industry?
They have a hybrid system with discounts. They have something called a reissue rate. If the property was insured in the last 10 years, or if you are refinancing, you get a discount, often around 10% to 30%.
Wait, hang on. I need to check my closing statement. I refinanced a few years ago. I did not know about this. I hope I got that reissue rate.
Many people miss it. You have to ask for it or make sure the title officer knows there was a prior policy. It's free money if you qualify.
That makes me so angry at my past self.
Ooh.
Okay, this is great practical advice, but let's pivot to the juicy stuff. Segment 5. Industry dynamics and controversies. You mentioned referrals earlier. My agent recommended a title company. Is there something happening behind the scenes there?
This is the elephant in the room. It's called an affiliated business arrangement, or ABA. This is when a lender, a realtor, or a developer actually owns or has a financial stake in the title company they are referring you to.
So my realtor says, use ABC Title. And it turns out my realtor owns ABC Title.
Or their brokerage firm does, yes. This is essentially a one-stop shop concept. The industry argues it's for your convenience. Hey, we can handle the loan, the finding of the house, and the title work all under one roof. Seamless.
Convenience is nice, but it sounds like a massive conflict of interest. If I'm hiring a title company to find problems, do I really want them owned by the person who only gets paid as the deal closes?
That is the exact question. Consumers seem to think it's a conflict, too, when they know about it. The Ohio Association of Independent Title Agents, or OAIATI, did a survey in 2009-2010. They found that 58% of respondents felt these arrangements were a conflict of interest.
That's majority.
And it gets more interesting. When people realized the referral came with a profit share, 50% said they would prefer an independent third party.
Because if the realtor owns the title company, is the title company really going to dig deep to find a problem that might kill the realtor's commission?
That is the fear. The fear is that the checks and balances are eroded. Of course, the industry has its own data. The Real Estate Services Providers Council cites studies from 2002 and 2008 claiming higher customer satisfaction with one-stop shopping.
We investigated ourselves and found that customers love us. I'm skeptical.
To be fair, convenience is a value. But legally, if an ABA exists, they must disclose it to you. You get a piece of paper saying, we have a relationship with this company and you are free to shop elsewhere. The problem is, that paper is usually buried in a 100-page stack you sign in a hurry at closing.
Right. Sign here, sign here, sign here. I probably signed 3 of those and didn't read them. Let's talk about the money. How profitable is this industry? You said claims are rare?
They are very rare. Let's look at the 2012 data from ALLTA. The industry took in $11.2 billion in premiums. They paid out $908 million in claims.
Okay, I'm looking at these loss ratios in the source material, and the math is blowing my mind. You're telling me that for every $100 in premiums they collect, They only pay out about $8 in claims.
Roughly, yes. In 2012, it was about 8.1%. They call this the loss ratio.
That is obscene. I mean, look at car insurance. If Geico collects $100, they are paying out $70 or $80 to fix crashed cars. Or boiler insurance, another inspection-heavy type, pays out 25%. Title insurance is keeping 92% of the revenue. How is that not just a massive scam?
If you ask the consumer advocates, it is a scam. They argue it's a reverse lottery where the house always wins. But, and I have to play devil's advocate here, the industry has a very specific defense for this.
Okay, let's hear it.
They say you are misunderstanding what you're paying for.
I'm paying for insurance. It's in the name.
They would say no. They say you are paying for prevention. Think of it like a security guard versus a theft policy.
Go on.
A theft policy pays you after you get robbed. A security guard stops you from getting robbed in the first place. Title insurers argue that the 90+% of the premium they keep isn't profit, it's the salary of the security guard.
I see.
They spend that money maintaining the title plants, paying the researchers, and fixing the 1 in 3 errors before the closing happens.
So their argument is, the reason our claims are so low is because we are so expensive.
Precisely. If they stopped spending that money on research, the claims would skyrocket. It's a risk elimination model, not a risk assumption model. The low payout is a feature, not a bug. It proves the system is working.
I get the logic. I really do. But then I look at the profit margins of the big four insurers, and I wonder if that security guard is really costing them that much, or if we're just paying for a monopoly. Because looking at the market share here, there isn't exactly a lot of competition driving prices down, is there?
Not really. It's highly concentrated. There are the big four families of insurers: Fidelity National Financial, First American Corporation, Old Republic, and Stewart Title.
How much of the market do they control?
In 2012, Fidelity had about 34%, First American 26%, Old Republic 13.5%, and Stewart about 13%.
So wait, let me do the math. That's over 86% of the entire market is controlled by just 4 companies.
Yes. Collectively, these 4 giants control the overwhelming majority of the market. Regional companies only make up about 13%.
So it's an oligopoly. 4 giant companies dominating the landscape.
Yes, which makes the shopping around advice interesting. You are often shopping between agents who are essentially reselling policies from one of these 4 big underwriters. You're not always getting true market diversity.
And since their revenue is tied to the housing market, they must have taken a beating in 2008.
They did. Revenue fell off a cliff in 2007. It's a highly cyclical industry. They have to bank cash during the boom years, like the 2000-2006 bubble where revenue doubled, to survive the busts when no one is buying or selling houses.
Okay, this has been a whirlwind tour of a piece of paper I definitely took for granted. So let's bring it in for a landing. What is the big picture here? Let's summarize.
The summary is this. Title insurance is the invisible shield that allows the American real estate market to function. Because we rejected the Torrens system, where the government guarantees ownership, and stuck with the bulletin board recording system, we created a massive gap in security.
A gap of trust. We don't know for sure if we own what we buy.
Exactly. And private industries stepped in to fill that gap. They monetize the risk of the past, they check the records, they fix the errors, and they insure against the unknown problems that they might have missed.
And for the listener, the so what seems pretty clear. First off, check your loan estimate.
Absolutely. Do not just blindly accept the provider your lender or realtor suggests, especially if you see an affiliated business arrangement disclosure. You have the right to shop.
Unless you're in Texas.
Unless you're in Texas. But even then, you can shop on service. But in most places, call a few independent title agencies, ask about their rates, and if you are refinancing or bought the house recently, ask about the reissue rate.
And make sure you get the owner's policy, not just the lender's policy. Don't leave your equity naked.
Critical advice. That's probably the single most important takeaway.
So here is the final provocative thought I want to leave everyone with. We pay billions of dollars every year, $11 billion back in 2012, surely more now, to private companies to maintain records and insure titles because we don't trust our own government to guarantee property ownership. We are paying a tax to private corporations for efficiency and risk management. So the question is the speed and flexibility of this recording system actually worth that extra cost to every single home buyer? Or was the rejection of the Torrens system a century-old mistake that we are literally still paying for every time we close on a house?
It raises a profound question about the role of government versus private enterprise in the most fundamental asset we have, our land.
Something to think about next time you see a for sale sign. Thanks for diving deep with us. We'll see you next time.